All right, I think we're live. All right. Hello, everyone. My name is Jayson Dubin. I'm the CEO of Playwire. I want to welcome to Playwire Live, where we tackle very hard topics around ad tech, specifically for publishers. Today, I have a very special guest, Chris Kane, who's the CEO and founder of Jounce Media. Obviously, arguably one of the most knowledgeable and prolific people in the space, who knows more about the buy and sell side of ad tech than anyone I know. For complete disclosure, we are a client of Jounce Media, and we do subscribe to the Jounce Media platform to make sure that we monitor all our publishers and make sure that we're hitting all the KPIs for both the supply side and the buy side. Chris, welcome to the show. Really excited to have you.
Thanks, Jayson. It's good to be here.
Awesome. So today we're going to talk about something pretty close to my heart, which is what are the main problems facing publishers today, specifically the mid-sized publisher. And when I say mid-sized publisher, I am talking about anyone who falls in the swath of $250,000 of gross revenue, all the way upwards of 20 million. That's how wide a spectrum this is, and this is how many people this is affecting. Publishers right now today are probably under more pressure than I've ever seen. You've got SGE, or search generated experiences, where Google is basically summarizing the answers, not sending traffic to the publisher. I think there was a report that almost as much as 40% of organic traffic will be taken away by some of these AI type machine learning. We have walled gardens. We have the TTD, or Trade Desk, putting out the S&P 100 and 500, where they're saying here are 100 and 500 brands that we trust and that you should buy from. And if you're not part of that 500, again, you're being squeezed out, which is really the mid-sized publisher. Obviously, cookies, it was an issue. And then most recently, we have COPPA that came out today, where that's going to be 17 and under, which is going to be a huge shift in how media buyers buy and how you can collect data. And probably the biggest thing right now is just the economy, right? The stock market is seeing some challenges these days, and when that happens, the agencies pull back. They do more performance advertising. They're looking for lower rates and more efficiencies. So the first thing I want to just talk about is if I'm a mid-sized publisher, I really can't go at this alone anymore. You need a partner who can navigate this, and more importantly, who the buy side will pay attention to. And I know you've put a lot of time around and effort around this specific topics, but I think some of the publishers would love to hear from the horse's mouth, why that's important, why you should work with someone. And again, it's a little self-serving, like Playwire.
Yeah, look, I think, you outlined a lot of headwinds there, and I agree with all of them. In terms of, demand generation, I do think there's a very substantial industry shift that has been underway and is going to continue over the next several years, where buyers meaning either the brand or the agency or the DSP, are increasingly aware that you just can't automate quality control. Like, it just doesn't work. I think that is evidenced in a lot of ways. The one that has probably gotten the most headlines over the course of the last year is made for advertising supply, which by all of the traditional measurements looks like fabulous inventory. And yet the great majority of marketers, when given a choice, say they don't want to deploy their investments there. Take that as sort of representative of a broader shift in the mindset of buyers who are saying, I got to operate like a marketer. I need to make a bunch of marketing business judgment calls that cannot be automated away. Or to say that differently, I don't trust the automated checks on quality for where I'm deploying my investments on the open internet. So I need some human oversight. I'm totally bought into that. I think that's absolutely right. And I think there's a long history of RTB traded supply being littered with inventory that creates no value for the buyer and that siphons ad spend away from publishers that do create value. So as a starting point, I think this direction of change that, buyers are going to apply more human oversight to their, to where they invest. And that means building these sorts of inclusion lists. Sounds great. The rub, which I think you're highlighting, is there are basically three classes of publishers that this affects. There are publishers that have low quality supply that doesn't create value for marketers that are going to be deliberately excluded. That's good. That's not good for them, but that's good for marketers and that's good for reputable publishers. There are scaled portfolios that will now capture excess budget or an increased share of wallet. That's good for them, and that's good for the marketer. And then there's publishers that are just going to get left out. They're not going to be blocked, but they're not going to be included either. They're just going to get forgotten about. That's the problem. There's high quality, low scale inventory that rationally buyers are going to overlook in this process of curating inventory. And that basically is the mid-market. It's the publishers that you just talked about.
Right.
And I think they really run the risk of not ever being blocked because they did anything wrong, but just being essentially too small to be worth the time of a buyer to evaluate. And they kind of just will get sidelined.
You mentioned the word MFA, and I think that's kind of a hot button. Like, so I think one, it's a moving target. I think everyone should or has a small portion of the inventory they buy. So at what point does a publisher transition from non-MFA to MFA? Like, where is that sweet spot? Or you're saying there really is no calculation, it's subjective?
Well, I think there's two things here. There is not a defined boundary of what is or is an MFA. Maybe I should talk about how we handle that, but there's no industry standard here, and there probably won't be. And I don't know that there should be.
I think it'd be helpful, right? I think transparency is what's going to get us to a better spot. If we know as a publisher what MFA is, we can fix it. But if we don't know, and it's like, hey, just fix the problem. I don't know how we get to a better spot as an organization, or let's
unpack that a little. So I think publishers absolutely deserve transparency. We think we hold a very high standard, meaning like we're very reluctant to call something MFA unless it is extreme. We're looking for inventory. We're looking for supply that is totally dependent on paid traffic. Unlike a normal publisher who might buy some traffic, we're looking for portfolios that are totally dependent on paid traffic, that overcome those traffic acquisition costs by aggressively monetizing user experiences, selling like 50 or more impressions per user session, and where the data that we track can identify or can kind of quantify that ads delivered on this inventory are highly unlikely to be attributed with driving sales for the marketer. And so we think that's what that means is supply that we call MFA is a big outlier. I can't speak to how other companies do this, but I do think, to your point on transparency, this should not be mysterious to publishers. And one of the things that we do is any publisher at no cost can reach out to me, Chris@JounceMedia.com. Feel free to email me. I'll tell you how we classify all your supply. You shouldn't have to pay for that. I think every other company in the space should do that same thing. That's not the same, though, as defining with specificity exactly where the line is. Because when you do that, MFA publishers will invent a way to live like right there. They'll just and so I don't at all support the idea that it is ad tech. This is the whole thing. It's that publishers, we were texting about this morning. It's that publishers, the greatest publishers on the world, the least great publishers in the world, all have a very bad financial incentive to manufacture the maximum amount of supply that is like just barely good enough. And we raised that bar. We said, MFA supply is not, but still the incentive is to be like just a hair over that MFA line and then manufacture as much supply as possible. That's a real problem.
Right. You almost gave me a layup here, which is, publishers in general are not rewarded for doing what I would say the right thing. So the question is, why should they, right? Should they, I know right now a big move is to represent their inventory to buyers, for example, calling outstream in-stream. And basically publishers make more money if they take a loose interpretation of the industry standards and stretch the truth on how they name their inventory. So if I'm a buyer and I know I can make more money, if I'm a publisher and I know I can make more money, and my hand is not really being slapped for doing it. And I'll make, I would say there's only one company right now, in my opinion, that's doing a pretty good job of this. And this is the Trade Desk, where, if you get put in the penalty box or doing something wrong with the Trade Desk, you are there for quite a while. So, but beyond the Trade Desk, there really is no incentive to do the right thing.
Mm-hmm. There is no incentive. And publishers are very, as far as I can tell, I've never worked at a publisher, so this is maybe a little bit of an unfair thing for me to say, but my perspective from the buy side of the industry is that publishers as a category are just totally rational operators. They do the thing that they are financially rewarded to do. Now, there's a handful of companies that don't, and I don't really understand why they don't do that. There's a handful of companies who like sort of take like a principled point of view that like, I don't know, we're like, there's like vague notion of playing the long game, but those are exceptions. I think most publishers just like do the thing that is revenue maximizing. And exactly as you said, that means stretching the truth. Now, that doesn't mean fundamentally misrepresenting inventory. Because if you fundamentally misrepresent your inventory, you say you're running ads on XYZ and you actually run ads on some other site. No, that is fraudulent. You will eventually get blown out of the industry. But if you take an ad product that is living in a middle ground between in-stream and out-stream and you call it in-stream, that is the rational move for a publisher.
But is that true? I almost question that. I almost feel like if you get put in the penalty box, again, other than TTD, they will just come back with a different flavor, a different color, and they'll somehow find a way back into the bid stream under a different URL or different domain or spoof something. And you know what? They make a ton of money and they get their hand slapped and they just come back under a different name.
Yeah, look, I think that is absolutely the case on a domain by domain basis. It's like a ridiculous pattern of history. I've been in the industry for 15 years. It's the same thing over and over again. Yep. One domain gets blocked and so you launch a new one. One way in which that is changing, and I think it relates back to this idea of like buyers having human oversight. The trade desk for sure is, way out ahead of the pack, but the rest of the industry is following. There is this move toward this sort of like reputational system, not of the site or the app, but the seller. You know what I mean? Like auctions operated by Playwire. Do I trust that or not? Auctions operated by Hearst. Do I trust that or not? Auctions operated by some other company. And in that way, you were talking about the penalty box. Like in that way, it is much, much harder for a company that is engaged in some sort of bad practice to sort of reinsert itself into the bid stream. That the trade desk, as you said, is far ahead of the rest, but like that's a thing that's coming. And I think that would be really healthy.
So on that topic, just kind of aligning incentives for publishers, and publishers make more money or top line revenue if they sell through what I would call dilutive multi-hop supply chains that extract unwarranted fees, right? So the agency to the DSP to the SSP to some intermediary to a company like ours to the publisher. So think about it, there's almost 5 hops in between. So, if they make more money by using these third parties, right? All these resellers, why should a publisher stop?
They shouldn't.
I know I have my reasons. I know I know what we've done.
I think it's real hard to unless you have like a very patient management team and set of investors who really are committed to the long term. I don't know how you as a publisher decide to not sell through any reselling supply chains. Now look, there's a point where excess reselling is so dilutive, like the middlemen take so much of a fee that you really experience top line revenue declines. But for most, I think for every publisher, they almost definitely leave money on the table if they're not monetizing through resold auctions. The really screwy part about this thing is there's like a collective action issue here. If no publisher monetized through resold supply chains, DSPs would spend the same amount of money, and more of that money would go to the publisher community. But any individual publisher can take shares from its peers by running resold auctions. And so it's this like super broken collective action problem where once a single publisher kind of like defects and starts selling through resold auctions, then every other publisher is rationally incentivized to follow. And the result of all of that is the publishers at large make less money and ad tech middlemen get to take essentially a toll on the industry.
So let me take the opposite approach. So we used to work with 25 SSPs. We're down to arguably 11 or 12 at this point. Out of those 11 or 12, there's one that we'd work with that is a reseller. And somehow, I don't know how, they're able to extract higher rates than all the other SSPs combined. And we're talking DSP, SSP, Playwire.
Yep.
Why should we stop working with them?
I mean,
should. Okay, so there's the answer.
No, exactly. But
it goes against everything you just said.
But if the entire industry, if Playwire and every one of your peers stopped working with all resellers, the entire publisher community would make more money. I mean, that just has to be true, right? The same amount of money would leave a DSP. There'd be fewer intermediaries taking fees, and so more money would get paid out to publishers. But your individual incentive is to run those resold auctions in order to take share from other publishers.
Yeah. All right, let me just go to the next topic. I think we could probably talk on this forever, but I only have about 15 more minutes. So in my opinion, I think this industry is full of contradictions. What I mean by that is viewability and completion rates have been the gold standard for as long as I can remember. But as we know, that's very contradictory because performance is not that high after the first few impressions, right? So after the first few impressions, the first few eyeballs, the rates go down, and I guess the attention span of that user goes down, and then that eyeball becomes less valuable. So loyal users, if I'm a publisher, I want to get loyal users that come back and spend a ton of time on my website, which I want as a publisher. But we continue to serve ads, and the advertiser continues to pay for those ads. However, that's not what the advertiser wants. The advertiser only wants the first 6 to 10 impressions, and then after that, it gets less valuable and less valuable. So they're completely at odds with one another, where we want to get a user for as long as possible and serve as many ads, and the advertiser wants as many users, but only wants to serve ads a set amount of time. So if I'm a publisher, or me as a publisher, which representing almost 1,000 websites at this point, what should I tell my publishers to look at? What metrics we be watching?
I think there's a lot to unpack in there. I think firstly, you are absolutely, let's just start with the observations from the buy side of the market. You're absolutely right that in a perverse way, or a counterintuitive way, the publishers that have the highest audience engagement tend to be the ones that have the worst performance for marketers, which is such an issue. I think what publishers are supposed to be doing to be a great media company is to make experiences that are so compelling that, exactly as you said, people keep coming back and they have long dwell times. But the data is quite clear that as publishers get better and better at that, the performance of their advertising goes down. And I mean, I think you can see this just in forget ad tech stuff, Google search, the amount of time people spend with Google search relative to the dollars Google captures is crazy. It's small time, giant. It's just in the right moment. And then you get these opposite experiences where people might be, watching videos of somebody playing a video game for 4 hours. And there are interstitials, there's banner ads. This is a publisher who's built a compelling product, sells a ton of ads, but the ads really don't work for marketers. I don't know if there's a way to solve that problem other than to say that publishers are definitely experiencing some tension of how do I create ad products that drive ROI for marketers versus how do I monetize my inventory in a way that maximizes my yield? And those are definitely not the same thing. It's sort of what you were getting at before, doing the right thing. I think doing the right thing means creating ad products that influence consumer purchase decisions. And publishers could certainly use better feedback, which I know is something you want to talk about. But publishers can make choices to make extremely high impact ad products instead of generating a giant volume of low impact ad products. But the yield maximizing thing to do today is to make a giant volume of low impact ad products.
Got it. Just for everyone who's on listening, if you have questions, you can ask a question. It will show up here. So I just want to make sure we leave some time for Q&A at the end if anyone's interested in hearing from Chris, Kane, or myself. I can tell you what we've done at Playwire, which has been pretty impactful. I know it's going to kind of wrap all these things together, which is we focus on what's called QPT, quality, performance, and transparency. So we want to work with quality advertisers that have quality content. The ad should be performant, and the T is for transparency. And if you want to add an S, it's sustainability. So we took a draconian vantage point of this, and 2 years ago we said, hey, we saw this coming, and we made all our publishers basically go not serve ads out of view, any kind of what I would say nefarious practices. We kind of made everyone stop doing that. Any publisher that was MFA or had questionable content, we kind of extracted them from the Playwire portfolio. And what we saw was pretty amazing. I'm telling everyone this on this call right now because these are fixable problems. There are solutions to kind of how do you combat what's going on right now, and that's really to get quality inventory that's performance transparency. So over 70% viewability. And when I say 70%, It's got to be all your ads. It just can't be like, hey, your first two are in view, and then you can refresh below the fold. Everything has to be over 70% viewable, and making sure you're not refreshing out of view. And it might seem basic, but it really is simple if you kind of do these things and you're sending the right signals and you're classifying it. All the things that we discussed today, what we saw was a huge improvement spike. Our CPM went up 180%. Our QPS went down 60%. So we're sending 60% less queries to the SSPs and DSPs. They were super ecstatic because it's less machine learning and power for them to manage all these things. And it was pretty exciting to kind of see the results. But it took about 2 or 3 months of pain, short-term pain for long-term gain. So if you're a publisher, you are going to see a decline of revenue for the first 2 to 3 months as the machines start to learn and get learnings from like how to value your inventory. But these are all solvable. I mean, in my opinion, Chris, I mean, I don't know what you think. I mean, everything we just talked about, they're very solvable.
I think when a user goes to a website, if the problem is I'm not getting enough demand to sort of like, make my unit economics make sense, yeah, that's a solvable problem. It's partly solvable through tech, right back to the beginning of what you were referencing with sort of like some of the buyer curation. A lot of this is politics too. You know what I mean? Like you need to have a voice, a voice in the room or a seat at the table when the big agencies and the big DSPs are sort of setting their defaults for what to buy. But like, yeah, those are solvable problems. I think there's some other structural things that are sort of like truly existential for publishers. But, finding sort of like a level, an RPM that creates a sustainable business is a solvable problem.
Gotcha. I think it was interesting. We kind of talked about like all the problems that we have that are solvable. I think a really good topic would be, what are some unsolvable problems that we're facing today? I know we touched on some earlier, but I think you just mentioned it. There are existential threats out there that I don't think any of us can really combat or know how to combat, right? Less organic traffic. Again, the economy is going to play a huge part in this. What's on your mind? Like, what are you seeing are things that me as a publisher should be looking out for that's on the horizon?
I always feel a little uncomfortable on these things because like I'm not an operator.
Good.
I don't live the day to day, but I don't live the day to day that publishers do, particularly mid-market publishers. And so I get to say sort of like big picture things, and then I realize it's sort of easy for me to say. But maybe that's also some helpful perspective of like broadly where the industry is going. As a percent of GDP, let's say, ad spend is going to go up or down. That ad spend mix is going to move inconsistently across different marketing categories, different media. But like marketers are going to keep spending money on digital media products. And I think publishers who, implement a lot of the strategies that you were discussing that become part of a large portfolio that does have a seat at the table with the DSPs and the agencies, like there will be tens of billions of dollars that move from DSPs to reputable publishers for the foreseeable future. It's even, maybe it got delayed or who knows what happens. Even things like addressability headwinds, cookie deprecation in Chrome, or a variety of other, these are very important, very painful tactical things that the industry will navigate. The real risk to an individual publisher is what the guys at The Verge call Google Zero. Like, do you have a business if Google stops sending you traffic?
Wow.
And I think for a lot of publishers, the answer is like, you don't. And like the business is existentially linked to a decision for a single company, Google, to send you traffic. Facebook's not sending you traffic anymore. That's gone. A bunch of other third-party referral sources have become irrelevant. And so like the existential risk to publishers is like, there's this one company who breaks my business if they stop sending me traffic. And they're working on a whole bunch of things to stop sending me traffic. You mentioned SGE. There's a real risk that some publishers will get pretty close to Google Zero. That's the one. That's the one that you just can't mitigate. And I think it's sort of a depressing thing to acknowledge, but like that is the reality. That's the really existential one for me, for web media companies.
You might know, this is an answer I would love to actually know. Like, so if I am a publisher, where would I, and I don't know the answer to this, by the way. So if I am a publisher, where else can I look to buy or get quality referral inventory? I mean, I know, especially with the combination of, I think it was Taboola and Outbrain recently. I mean, those have been probably that's probably the largest two players. So now they're one. But beyond that, I don't know any other place to
Well, I
get
think
real traffic.
I mean, okay. So there are at least two strategies that can make sense here. I'm gonna go back to the MFA thing. Most publishers buy traffic. Most publishers are going to have to buy more traffic next year than they're buying this year because they're getting less free referrals from Google and Meta and others. And so I think there is a very important thing that I spend a lot of my time thinking about. What's the distinction between made for advertising and publishers
Right.
that engage in sort of like healthy, productive traffic acquisition? Um, and we can talk about that in more detail. But like that healthy, productive traffic acquisition does exist, and there are publishers that buy a lot of traffic that we don't call MFA, that I don't think anybody should call MFA, and like that's going to need to be a discipline that web publishers figure out over the next couple of years. Mobile app developers, by the way, are excellent at this. Like casual game
Mhm.
developers buy all of their traffic. No one organically installs some casual game. You advertise those on Facebook and you buy your users, and then you get very disciplined about comparing customer acquisition cost versus lifetime value. Web publishers are going to have to get good at that. The other thing that is probably worth highlighting is distribution deals. Deals where the publisher distributes its content on other platforms. Those could be other platforms like Yahoo and MSN. Those could be platforms like Meta, where you
Right.
essentially become a content provider that syndicates through third-party platforms that do have organic audience.
Okay. Uh, Last question I thought I'd just throw out there. It just came out today, and that's, COPPA moving up to 17 years of age. I don't know if you have a POV on that. What's your perspective? How is that going to affect the market? Obviously, if you can't collect data on these users and they're not addressable, that really changes a lot for a huge swath of inventory. If I'm a publisher, how should I be thinking about that?
I don't know the depth there. I don't know the details of how the sort of the regulatory framework is changing. Um, but I do sort of like subscribe to your general line of logic that like this is like another bullet point on the list of headwinds that publishers are going to have to deal with.
Right. I can tell you we live and breathe in COPPA. We're arguably one of the largest aggregator of COPPA inventory, both on the buy and sell side. And the variances are massive when it's addressable versus our direct deals. So unfortunately, there really is no programmatic in COPPA because there's no addressability, there's no cookies.
Right.
We can't trust anyone to basically with COPPA, they're not allowed to change they can't change the creative. There's all kind of restrictions. You can't collect data. So if we run a campaign, we only run direct campaigns on our COPPA partners. So I can tell you the delta in, what I would say and by the way, we only work with one partner, which is Google, by the way, to fill the inventory. If they can't fill it, we don't work with nobody else. And the CPMs are like 10x different.
Well,
So
maybe here's like a broader framing of this thing. So much of what you just talked about are fixed cost problems. Like it's the same amount of effort for a standalone $250,000 a year publisher to solve that problem as it is for Hearst or Condé or Dotdash Meredith. But the ability for a small publisher to invest in the right solutions is nowhere near what it is for those companies. And so it does seem to me like the go it alone strategy for mid-market publishers is becoming less and less tenable, and that you need to either be part of a large owned and operated portfolio or need to sort of have partners that can make these fixed cost investments and then apply them, whether it's COPPA compliance or lobbying to be on the trade desk SP 500 plus or whatever, that you're going to need partners who can justify these fixed cost investments.
Awesome. All right. We're at 30 minutes, so I'm going to be respectful of your time and everyone's time on the screen. If you want to reach out to Chris, it's chris@jounce.com. Is that it?
At jouncemedia.com.
chris@jouncemedia.com. And if you want to reach out to myself for any questions, it's jdubin@playwire.com. Chris, thank you so much for having you. Thanks for joining us on the show. And hopefully we'll have you back for another Playwire Live.
Thanks, Jayson. Appreciate it.
Thanks, everybody.